years, we went through two bear markets, a banking crisis, a pandemic, and a recession. But I managed to grow my portfolio at 145% over the last 5 years and over 45% last year, making over $2.1 million in gains. In last year's Market Outlook 2023, there were 5 stocks that I asked people to focus on. They were Amazon, Meta, Microsoft, Salesforce, and Google. And we're only at the beginning of the AI and automation revolution. This is one of the safer times to invest in a stock market. In this Goldilocks market and economy, it's going to be a lot easier to generate profits with a lot less volatility. So that means there are great opportunities to buy the right stocks at discounted prices when you know how to find them. Now the good news is that it is only the beginning. So good morning, or good afternoon, or good evening, depending on where in the world that you are catching me from. By the way, where are you guys from? Let me know. Okay, Canada, I see Singapore, I see Malaysia, I see LA, I see Hong Kong, I see Hawaii, I see Ang Mo Kio, I see too many to mention, Korea, Qatar, South Africa, San Francisco, Trinidad. There's a whole map of the world, Dubai. Wow, wonderful. So once again, it's great to see all of you here today and welcome to this webinar. Thank you so much for being here. And we're going to start today's session by doing a review of what happened in the markets in Now, it's great to make money, but it's even more important to learn lessons every single year so we become a better investor and a better trader, and we get better results in the future. And the second thing I'm going to focus on, of course, is what can we expect in 2024? Where do we see the markets this year in terms of the economy, in terms of the markets? What could go right? I think a lot of things could go right in this Goldilocks market and economy. But at the same time, what could go wrong and what we can watch out for. I also talked about the specific sectors I think could outperform the markets this year, as well as the specific stocks that I'm focusing on that I think can continue to do well. At the same time, I'll do a live Q&A session at the end of this webinar. So stay all the way to the end, ask any questions that you want, and I'll do my best to answer all your questions. We're also going to have a special offer for my Wealth Academy Investor Masterclass, where I teach live via Zoom online. And that's like 4 days live with me, together with another 6 more days of coaching and additional sessions. So look out for that offer. We also have an offer for the Ultimate Investors Playbook, or UIP, where you get to watch how I invest and trade live every single day. So all that's happening, so get ready, all right? So without further ado, let's begin. So let's begin by doing a quick review of what happened in the markets last year. So from this chart, you can see generally markets were bullish last year, especially the US market. It was record bullish. So the S&P 500 closed up 23.79%. Now bear in mind, all these numbers you see are not including dividends. So if you include dividends, it's a bit higher, yeah? And later you may see certain charts that include dividends, so it would be slightly higher in certain charts, yeah? The Dow Jones gained 13% last year, the NASDAQ 100 gained 54%, so the US market was a clear leader again. In second place was the Indian market, with the Nifty up 19.19%. By the way, this is without adjusting for currency. This is based on the currency of the different markets. In third place, we have got Europe. The Euro Stocks 50 gained 16%. And then we have the UK coming in at 2.37%. And my home country, which I love, but not the market, is down slightly last year. And of course, China really disappointed. China had a third negative year in a row, down 15%. So anyway, let's focus on the US markets, which did really well. By the way, question, why did the US markets do so well last year? Was it because everything was smooth sailing? There were no crises, there were no problems. Everything went according to plan, yes or no? Were there no problems? Were there no crises? No, there were a lot of problems, there were a lot of crises. So, in fact, take a look. We started last year with the regional banking crisis, if you recall, where a lot of people said, oh my God, it's going to be another financial crisis. Silicon Valley Bank collapsed in March, and the largest US banks lost billions in value, and then First Republic Bank collapsed in May, and another bank collapsed. I recall, I forgot the name of the bank. And then in July, the Fed raised interest rates to its highest level in 22 years. And then Fitch, which is a rating agency, downgraded the US debt. And then mortgage rates in the US hit the highest level in 20 years. People said that the housing market would collapse. And then with the auto workers that launched a strike in September, and we had the Hamas-Israel war that started in October. So there were a lot of things to worry about. There were a lot of crises. But despite that, the stock market kept going up. So there's a very old saying that says, the bull always climbs a wall of worry. Remember that. The bull always climbs a wall of worry. The more people worry about shit, the more the bull will climb that wall of worry. That's just how the market works. Now, the trouble is, there are a lot of people who say, I will only invest in a market when there are no more problems, when everything is resolved, when everything is certain, when there's nothing to worry about. Let me ask you a question. Will the day come when you have got no more problems, when there's nothing to worry about? Yes or no? Yes or no? The answer is yes. There will be a day when there's no more problems. It's called death. Right? Only when you're in a graveyard, there's nothing to worry about. So if you're waiting for that day, I'm sorry, you will never start investing. Okay? So the time to start investing is a time when everyone's worried, because the bull always climbs a wall of worry. Remember that. Now, as you guys would have also heard, last year, the 20% gain in the S&P 500, majority of those gains came from only 7 stocks. Most of it. All right, so take a look at this chart. You can see that this is called the Magnificent 7 stocks: Amazon, Meta, Google, Tesla, Microsoft, Apple, Nvidia. By the way, Tesla was just kicked out of the Magnificent 7. So it's no longer the Magnificent 7. From now on, it's called the Super 6. Tesla's been kicked out because Tesla has a lot of problems right now. It looks like it's not going to grow anymore. And anyway, topic for another day, right? So anyway, but in total, the Magnificent 7 grew 105% last year, versus the rest of the 493 stocks in the S&P gained just 7%. Okay? Now, question, why? Why? Why did the majority of gains come from these 7 stocks? The answer is very simple. Earnings. Earnings, write this down. Remember that at the end of the day, what drives stock prices? At the end of the day, it is earnings growth. It's as simple as that. Take a look at this chart and you understand why. You will notice that the whole of 2023, over here, check this out. All right? From quarter 1, quarter 2, and quarter 3, 2023, and by the way, right now, we're in the middle of the quarter 4 results announcing period. Now, what you see in dark blue, that's the earnings growth of the Magnificent 7. And the orange bar is the earnings growth of the rest of the 493 stocks in the S&P 500. So you will notice that last year, it was only the 7 stocks where the earnings were growing. The profit growth came from only the 7 stocks. And most of the other stocks, like financial stocks, healthcare stocks, industrial stocks, from the rest of the S&P, the earnings growth was negative. The earnings were declining. That's why their stock prices didn't go up. Can you see what I'm saying? Now, here's the good news. The good news is that for all the other sectors, finance, healthcare, industrials, they went through an earnings recession last year, where again the earnings were negative, but now their earnings are beginning to grow again. So for the next, the next 12 months, can you see the rest of the stocks, their earnings are projected to grow this year, which is great, which means the other stocks, their stock prices will now begin to catch up. They'll begin to catch up with the rest of the Magnificent Seven, right? Now, how about the Magnificent Seven? Are their earnings going to continue to grow? Yes, because they're in what we call a secular growth trend, where AI and technology and automation is not a one-hit wonder. It is something that's going to grow for the next 10, 20 years. Although you can see for the Magnificent Seven, their earnings growth is going to slow down. Yes, it's going to slow down, but it's still growing. So the Mag 7 is going to grow, except Tesla. The rest of the companies are going to grow. So now what's happening is that the bull market is not just confined to 7 companies. Now the bull market is widening to all the companies. And this is how the bull market gets stronger in this year. Does it make sense? Okay. Now, last year, as I've showed many of you my performance reports every single year, my US portfolio, I've got 2 main US portfolio, up 48% for this one, and gaining about 1.1 million. My second portfolio up 43%, gaining 978,000. So in total, I gained about close to 2.1 million US dollars last year, with return of on average 45%. So the reason why I managed to beat the S&P 500 is because I focus on only the high quality companies, the top 1% of stocks in the market with the most predictable, the most resilient, and the most consistent profit growth. So one of the lessons to learn is this: in times of crisis, write this down, in times of crisis, when the Fed is raising interest rates like crazy, only the high quality companies with consistent profits, they will do well. But companies with negative return, companies that are losing money, companies with very inconsistent profits, they will collapse during times of crisis. That's why it's really important to ensure that in your portfolio, you only hold high quality companies that are bulletproof, that can weather any storm, whether it's high interest rates, low interest rates, high inflation, low inflation, economic growth, economic recession. It doesn't matter. If you hold the top 1% of companies in the market, they will continue to do well. Okay? By the way, my returns are not super high. In fact, many of my students got much higher returns than me. I post some of my students' results. If you're in my private Discord chat group, you can see all my students sharing their results. Most of them did better than me. It's not because they are better than me, okay? It's because I'm very, very conservative. So for example, in my portfolio, I've got 40 stocks right now. And are all my 40 stocks growth companies? No. Only 50% are growth companies. The other 50% of my stocks are very defensive companies like Pepsi, like Hershey's, like McDonald's, like United Health. Very low growth but defensive companies, so that my portfolio is less volatile. All right, but despite that, it's still growing at 40%. Number 2, I don't use any leverage, 0 leverage, and I trade options to turbocharge my returns. But less than 5% of my portfolio is used to trade options, less than 5%. So I'm very, very conservative. One reason is because I'm like 50 years old right now. So it's like, I want to be very conservative. But many of my students, they concentrate only in growth stocks because they are younger than me. They're more aggressive. and some of them use a bit of leverage, and some of them they use like 20 or 30% or 50% to trade options. So because of that, you can see they get much higher returns. Like this guy, Tony, not from Vietnam. By the way, he's been a very constant feature. He's been sharing his results now for, I think, the last 4 years straight. And check it out. I mean, this guy is amazing. All the way from Vietnam, trading the US markets after taking my course back in 2019, I believe. He said that, I'm very happy because the investment results in 2023 was once again exceeding my expectations. And he got 131% return last year, right? I'd like to express my sincere thanks to Piranha Profits team. UIP, which is the ultimate investor's playbook with a combination of long-term investment and short-term trading, especially options, is one of my best investments during the past 3 years, all right? And this guy, Andrew, 200% return last year. Again, most of them get much higher returns than me, okay? So, returns than me. He said, it's been 2 years since I enrolled in your Value Momentum Investment course, VMI, and trading courses. And like to take this opportunity to express my heartfelt gratitude to your mentorship, right? And Juan Shin from Malaysia. Any Malaysians in the room, by the way? Malaysians, right? He said, I started investing in options trading a few years back because of my uncle who took your course, advised me to study your YouTube video, blah, 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 and he got 76% return last year, right? Malaysia bully, yeah, that's right, okay? One last one, Joshua, he said, I'd like to show my appreciation for your knowledge, sharing how investing can be made less risky by following the strict rules and understanding the company's fundamentals. In early 2022, I was down 50,000. That's when I chanced upon your YouTube videos that we should only invest in the top 1% of companies with good long-term fundamentals, and recoup all my losses, and now up 40%, close to 6 figures in my entire portfolio. All right. So anyone can do well, right? Anyone can do well, whether you're from Vietnam, from Malaysia, from Singapore, from the US, anyone can do well, but you have to educate yourself. You got to learn how to select only the top 1% of companies in the world, know exactly when to buy them when they're undervalued, learn how to trade options to turbocharge your returns, and you can beat the market consistently, right? Let's do a quick recap of what are the important lessons we can learn from last year's market, right? Lesson number one, and again, this is not a new lesson. It's something that I've been sharing for a long time, but I want to, again, reinforce it. Lesson number one is never listen to the predictions of economists and analysts. And the reason I call them analysts is because when you listen to these people, you get screwed in the... I wouldn't say it. You guys say it, right? You fill in the blanks in your mind, okay? Now, if you guys recall, at the end of 2022, almost all the experts said a recession is inevitable in 2023. The majority of all these experts said there's going to be a bigger market crash. The economists on 18 November said why a global recession is inevitable. And then in January of last year, stock markets are set to crash 37%. And then Deutsche Bank said the stock market will fall 25% when the looming US recession hits mid-2023. And then in March last year, this guy, Jeremy Grantham, while he was buying stocks, on one hand, on the other hand, he was announcing to the media that the S&P would plunge 50%. So never listen to all these people. I call them the prophets of doom, or the doomsday porn stars, if you will. Okay? So why shouldn't we ever listen to the predictions of all these experts? Because remember, nobody can predict the future. There are too many moving parts. You can't predict tomorrow's news. You can't predict how the market will react to tomorrow's news. Heck, I've been married for 23 years. I can't even predict my wife's emotions the next day. If I can't even predict the emotions of one woman, how can I predict the emotions of millions and millions of investors in the world? It is impossible. Okay? And some people ask me, Adam, should I listen to your predictions? The answer is yes or no. Should you listen to my predictions, by the way? I'm going to make certain predictions. Should you listen to my predictions? The answer is no. Don't listen to my predictions as well, because I can't predict the future. Okay? So don't listen to anyone at all. The great news is this. Beating the market and getting great returns has nothing to do with listening to predictions. It's got to do with following your investment plan and your trading plan. So for example, in my investing plan, I only invest in the top 1% of companies in the world. That's it. And once their share price drops below the intrinsic value to a level of support, I just buy shares. Simple as that. I don't care whether I predict the market's going up or going down this year. I don't care. As long as my great company is undervalued, I just buy. That's it. Because I know that these great companies, once they drop temporarily, they will bounce even higher. Same thing. If you are a short-term trader, I trade as well using my options techniques. I trade not based on predictions, based on the technical trade setup. So if I see a certain trade setup, I take the options trade. And these are the trade setups that you learn in the options courses, right? Based on technical analysis. So that's lesson number one. Now take a look at this chart. And you can see, for example, over a 15-year period, this was from about 2009 to 2023, okay? And during this period, the US market gained 500%. But do you think that most investors gain 500% at least in these 15 years? No. I can tell you the majority of investors lost money out there who are not educated in the markets. And most investors who made money made much less. Why? Because along the way, they listen to market predictions and they get scared out of the market. They get shaken out of the markets. Or they don't even start in the first place. So take a look at all the market predictions over the years. They will all scare you to get out the market. 87% risk of stock crash by the year end over here. Stocks and bonds will crash soon, right? It's always some guy telling you the market's going to collapse. If you just ignore market predictions and just buy the index ETF, you gain 500%. But if you learn how to pick the top 1% of stocks, you would double and triple this result easily. Because I have done it, my students do it all the time. Okay? But if you listen to market predictions and you get scared out of the stock market, you put everything to cash, or you don't even start in the first place, you put everything to bonds, then you just get 25% return in bonds, right? Versus in the stock market. So remember lesson number one. Okay? This only applies to the US market. Sky, right? Only applies to the US market. Now, lesson number two. And in 2020, in fact, last year, I would say that this really reinforces this lesson. Okay. Now, just to share with you, last year, which were the stocks I had that did not do well? Estee Lauder. My Estee Lauder went down 40%. Okay. Disney, my Disney didn't do well, and I sold it. I cut my loss on Disney. Boston Beer didn't do well as well. As well as, of course, a lot of the China companies did not do well. Right? Now, which are the stocks that did very well for me? Nvidia, Microsoft, Amazon, Google, so on and so forth. So when I look back, why? Why did those stocks not do well? Because they did not have consistent profit growth. Like Estee Lauder, the profits were declining because of some short-term problems. Disney, same thing. Their profits did not grow very much because of their transition to streaming. Boston Beer was still having an inventory glut, so their profits were not growing as well. Okay, so one of the things that I really reinforced in myself is that I should only stick to investing in high quality and predictable stocks, and not get tempted. Don't get tempted to buy low quality or unpredictable stocks just because they look cheap. Now, be honest with me. How many of you, honestly speaking, you have bought low quality stocks or stocks that are not very predictable because they look cheap? How many of you? And you avoided the high quality stocks like Google and Microsoft and Nvidia because they look expensive. You avoided them because they look expensive. You realize that? So one of the things you have to learn is that very often the strong get stronger and the weak get weaker, right? So one of the things that I've learned in my investing career is that it's better to buy only high quality companies, even if you have to pay a slight premium to it, rather than being a cheapskate and buying cheap stocks because they look damn cheap. And a lot of times the reason they are damn cheap is because they are low quality.